Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 3rd, 2014. Interesting week in the market this week. Get back to the basics, however. We're in bullish normal conditions. On an annual basis, using weekly RSI 14, we've pulled back to the middle of neutral at 57 out of 100. On a shorter term basis, using the 10-day NDX, we are oversold with a score of 12 out of 100. Price relative to the 200-day moving average is red bullish at 4.27%. That means we're about 2.25% away from a sideways market. We're still above the 200-day moving average, 2% above that 200-day moving average, so we're bullish. But the red color code means that this is among the worst readings that we've seen in the past 6 months. Slope of the 50-day moving average is yellow neutral. The ADX has increased to 21.2 with bears in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average. That score comes in at 0.91. That's below the threshold of 1.0, so we are in risk-off conditions. When we take that score of 0.91 and compare it to the last 5,000 trading days and find the standard deviation, we come in with a risk Z measure of minus 1.17. Here you can see the 90 days, the last 90 days of that indicator, and you can see that we're now below one standard deviation below the 20-year average. So this is an extreme reading on the VIX in the short term. When this rolls up, we would be looking at swing trade opportunities and intraday opportunities on XIV. However, as long as this continues to plummet like that, there's short side intraday only opportunities on the VIX using symbol VXX or UVXY. I don't carry those positions overnight. In the blended monthly rebalancing, the next reevaluation is due on about, that should read 1 September, sorry. The current holdings you see in front of you and the current leaders based on the close on Friday. In ETF2, the theoretical exposure is at 60%. The model portfolio itself will be at 60%. Here's just a quick look at the blended monthly rebalancing portfolios for some of those, the 13 ETF and the 32. On this page, you can see that we now have 4 symbols on a cash position, strongest being emerging markets, weakest being U.S. small caps. In the ETF 32, almost half of them now are on a cash signal. Again, you can see they're leading the way here with China, the BRICS, Brazil, and emerging markets. This is the ETF Max, which features about 1,300 ETFs, and it's dominated on the upside by India, emerging markets, some energy complex, some China, more emerging markets. This is the blended monthly rebalancing looking at the S&P 500, and it includes a sector ranking of, or a sector spider for which each of these high performers is founded. So Wyndham Holdings, for example, is a technology buy, and that's in XLK. So those that are on green and white, green on the 3-month, white on the 6-month, are ones that are outperforming dramatically on the 3-month return, but not so much on the 6-month, and so that could be a sign of emerging strength. So like international game technology would be of interest. There could be more in that one. Netflix, Vertex Pharmaceutical. Those, on the other hand, that are white and green are ones that seem to be stalling out a little bit. So like Neighbors Industrials is white on a 3-month and green on the 6-month. So that could be longer into its life cycle of outperformance. So market health check, you can see the sell-offs from Thursday and Friday really produce a system shock here, a 3Z adverse move here. It's well out of the river, well out of the floodplain, and right at the edge of the 3-period Bollinger Band. And that ends in a doji. And so since we're in a bull market, that would many people are going to see that as a buy on dip opportunity or an overreaction pattern. In fact, when we look at the daily report, we're going to see almost all the indices are on an overreaction signal. And so that's going to be a market condition rather than individual sector signals, in my view. I'm looking at getting bullish again if the price gets back above 197. Right now, I have a downside bias because we're in the red zone, and so signs of weakness where failure below the previous day's low is an auto short for me in that direction. It doesn't take any convincing to go on the short side. Support levels here are price targets. Price targets at 194 and then 199 are places where I would see short-term profit targets being set, and then hesitation at those would be reason enough to sell. The horizontal red lines are support levels that used to be resistance levels and which, when breached, act as price targets on the downside, heading down to the 200-day moving average, which you see here. You can see in this sine wave looking line here, that's the slope of the 30-period regression line. You can see how that has been decaying, and this is the second leg down of that. The thick black line in the middle is the 30-period regression line, lagged by a day, and then the channel is the outer black lines formed by the maximum excursion from the mean, or from the regression line during the look-back period. That happened on Thursday. The blue channel is the 10-period regression channel. You can see how that's sloping downward. So price has fallen out of the river below the floodplain at the Z-3. Found a bit of support on Friday, but a lot of indecision, a lot of intraday travel in there. And so I'm expecting a lot more volatility again in the coming week, what with threats to peace and some very serious concerns about global pandemics complicating an already complicated political agenda. This is not a time to have conviction about directionality of the market, in my view. Moving to the ETF regional report, we've got 4 out of the 6 symbols in the regional report on cash, so that puts us at 60-40 in the allocation strategy. The U.S. at 68 is better than the rest of the world at 65. So it's the U.S. over the globals for now. Inside the U.S., the strength is in the U.S. tech, then the large caps, then the small mid caps, then small caps. 2 strongest sectors in the world right now: emerging markets at 74, U.S. tech at 73. The 2 weakest sectors are U.S. smalls at 63, and then the European 350 at 62. Inside the U.S., the strength is in technology, energy, and healthcare. Weakness in utilities, consumer staples, industrial, and financials. World market model. Everything in the U.S. now is below average except for the S&P itself, and then large cap tech. Japan and Asia less Japan are above average. You can see the Asian leaders: China, Hong Kong, Taiwan, India, Thailand, Philippines, Indonesia. Nothing underwater there. In Latin American emerging markets, it's emerging markets featuring Brazil, Mexico, and Canada. All of Europe below average. The other asset classes starting to do a little bit better. Only commodities suffering, but silver, treasuries, and U.S. real estate continue to do well. In the global battles here in between the business sectors, a slight hat tip to the U.S. Strength in tech across the board in healthcare and energy. Here's the ETF top 30 based on the ETF2 model. And again, see dominated by India, precious metals, Brazil, emerging markets, biotech. And then inside the Dow, looking through the same lens, strength leaders Intel, Cisco, Microsoft, and some emerging strength in United Health and Disney. Weakness in Walmart, Boeing, and United Tech, which are failing faster than the world around them. Get that reading based on the fact that they are yellow on consistency but red on relative strength. So it's getting relatively worse in the shorter term than it has been historically compared to their peers. ETF liquidity, just for reference. Shifting to the Tortoise Daily Report now. Again, you can see we got a ton of symbols on the overreaction and the channeling. Plenty to choose from on the swing setups and the auto framer. Really, this is a market condition favoring all of these. And so I would pick your favorite targets, let the market show the way in the morning, and either ride the market down or find the strength leaders if the market's going up. That's how I will be playing it all week. Dow Tactical Summary, basically anything you want is on a channeling and an overreaction. There's a handful of 5DDs, 4 triple screens, a 551W in Visa. More than half are on a single-digit RSI2. We've still got some good frog candidates. And you can see the strength leaders from Friday, Procter & Gamble and GE, and then the percent losers, American Express, Morgan, IBM, Goldman Sachs, and Home Depot. Among the ETFs, just about everything is on both channeling and overreaction. Got some 5DDs in oil, Europe, blended commodities, and energy. And then 4 nice 551W candidates in Brazil, Latin America, emerging markets, and coal. And then you can see the max pain range compression ratios, all of which, and then the auto framer, which all test out better than 2 to 1 in the short term. In the auto framer, got just cut it off at 3.0 or better on the reward to risk ratios. There's plenty to choose from here with McDonald's, Coke, Caterpillar, and Travelers, United Tech in the top 5. And the regression line fractals, again, lots of winners to choose from. You might think that the ones in the red here, the ones that are the most ATR above their own regression line 270, there would be an urge for winning positions to be preserved, and so they could be very vulnerable if we get some more weakness on Monday. Again, these reward to risk ratios are measured in terms of ATR. That tells you how many ATR there is to the 270 regression line, which we're treating as fair value. Finally, from the market mosaic, see we terminated with a little doji here as the market rolled over. We pulled back to a full standard deviation below the 6-month average of the 30-period regression line. You can see how fast we pulled away. And then almost 3 standard deviations from the recent swing high with price relative to the 200. Just some things I want to highlight here. You can see the increase in volatility from recent lows 35 days ago. You can see how the slope of the regression line has rolled over, now gone below the 10-year average and pulling away. remainder are just good stats for you. I'd like to just see where we are here. The 10-day regression line slope is 2 sigma. Each time there's been a sharp response. The last 2 times that happened. This last time the 30 had already pulled way back too, and here as well. So this is sort of natural, a natural state when the price and the 10 start pulling the 30 down, just crossing below its zero line to go negative. And then you can see that the 90 has rolled over and re-entered the normal channel between plus and minus 1 z-score. You can see graphically what the magnitude of that sell-off looks like. And the last 2 times the market did this, there was a nice recovery in the long term. And that's everything I want to talk about for today. We'll get this uploaded, and we'll see you in the chat room and on the webinar tonight for subscribers. It's Ken Law from Tortoise Capital. Keep your risk measured and your powder dry.